Today on Open Exam Prep, we're focusing on a critical area for the SIE exam, which is understanding the different types of bond risks. Specifically, we will cover call risk, inflation risk, and liquidity risk. These concepts are guaranteed to appear on your test, and the questions will require you to differentiate them in various scenarios. Let's start with call risk, which is inextricably linked to reinvestment risk. A callable bond gives the issuer the right, but not the obligation, to redeem the bond before its scheduled maturity date. Why would an issuer do this? The answer is simple: to save money. This typically happens when interest rates have fallen significantly since the bond was first issued. Imagine a corporation issued a 30-year bond with a 7% coupon a decade ago. If prevailing interest rates for similar bonds are now only 3.5%, the company is paying way more in interest than it needs to. So, it will call the old, expensive 7% bonds and issue new ones at the lower 3.5% rate. For the issuer, this is a great deal. For the bondholder, it's a major problem. You get your principal back, but now you have to reinvest that money in a much lower interest rate environment. The income you were counting on for 30 years has suddenly vanished, and any new bond you buy will pay significantly less. This is reinvestment risk. On the exam, you must remember this cause and effect. A significant drop in interest rates is the trigger for call risk, which in turn creates reinvestment risk for the investor. Next, let's discuss inflation risk, which is also known as purchasing power risk. This is the danger that the fixed payments from your bond will be worth less in the future because of rising prices in the economy. Bonds are particularly vulnerable to this because their coupon payments are fixed. If your bond pays you $100 in interest each year, that amount never changes. However, what you can buy with that $100 definitely changes. In year one, it might buy a full cart of groceries, but if inflation runs at 5% a year, in 10 years, that same $100 might only buy half a cart. Your nominal return is fixed, but your real inflation-adjusted return has plummeted. The SIE exam often tests this concept by asking which investors are most harmed by purchasing power risk. The classic answer is someone retired and living on a fixed income from long-term bonds. As they get older, the cost of living goes up, but their income from the bonds stays exactly the same, squeezing their finances. Finally, we have liquidity risk. This is the risk that you won't be able to sell your bond quickly at a fair, predictable market price. Not all bonds are created equal in this regard. The market for U.S. Treasury securities is the most liquid in the world, with trillions of dollars trading hands daily. You can sell a Treasury bond in seconds for a price that is very close to the last quote. However, the situation is completely different for other types of bonds, like those issued by a small municipality or a little-known corporation. The market for these can be very thin, meaning there are very few buyers at any given time. If you needed to sell one of these bonds in a hurry, you might be forced to accept a deep discount, or what traders call a haircut, just to find a buyer. The exam will test this by asking you to compare the liquidity of different securities, and you should always remember that U.S. government debt is the benchmark for high liquidity, while municipal and certain corporate bonds carry significantly higher liquidity risk. To tie these concepts together for exam day, remember this simple phrase: the CEO calls to say, inflation liquidated our profits. This phrase directly maps to our risks. Calls reminds you that issuers call bonds when rates fall, creating reinvestment risk. Inflation reminds you that rising prices eat away at the purchasing power of your fixed coupon payments. And liquidated reminds you of liquidity risk, the potential inability to liquidate or sell your bond quickly at a fair price. Thinking through this sequence will help you correctly identify and apply these crucial bond risks in any exam scenario.